Alright, let's get into it. Sole proprietorship is the first form of business entity. The sole prop is the simplest business form and is not a legal entity. Sole prop is the easiest type of business to establish, which means that there is no state filing required. It is simply an enterprise owned and operated by an individual. By default, once you start selling goods or services, you have created a sole prop. So there's no actual filing requirements, and you simply report your business earnings on your personal taxes. A sole prop is not legally separate from its owner, and it offers no personal liability protection. The law does not distinguish between the owner's personal assets and the business's obligations. In fact, a sole proprietor's assets can be and often are used to satisfy the debts and liabilities of the business. In other words, if your business gets sued, your personal assets, such as your house, car, or any other properties you own, may also be in risk. Accidents happen and businesses end all the time. Such circumstances may quickly become a nightmare for a business owner who operates as a sole proprietor. A sole prop can operate under the name of its owner, or it can do business under a fictitious name, such as Benjamin's Hair Shop. The fictitious name is simply a trade name. It does not create a legal entity separate from the sole prop owner. The sole prop is a popular business form due to its simplicity, ease of use, and nominal cost. A sole prop need only register his or her name and secure local licenses, and the sole prop is ready for business. The owner typically signs the contracts in his or her own name because the sole prop has no separate entity under the law. The sole prop owner will typically have customers write checks in the owner's name, even if the business uses a fictitious name. Sole prop owners can and often do commingle personal and business property and funds, something that partnerships, LLC, and corporations cannot do. Sole prop often have their bank accounts in the name of the owner. Sole proprietors need not observe formalities such as voting and meetings associated with the more complex business forms. Sole props can bring lawsuits and can be sued using the name of the sole proprietor owner. Many businesses begin as sole prop and graduate to more complex business forms as the business develops. Because a sole prop is indistinguishable from its owner, sole proprietorship taxation is actually easy. The income earned by a sole prop is income earned by its owner. A sole proprietor reports the sole proprietorship income and losses and expenses by filing out and filling a Schedule C along with the standard form 1040. Your profits and losses are first recorded on a tax form called Schedule C, which is filed along with your 1040. Then, the bottom line amount from Schedule C is transferred to your personal tax return. This aspect is attractive because business losses you suffer may offset income earned from other sources. As a sole proprietor, you must also file a Schedule SE with Form 1040. You use Schedule SC to calculate how much self-employment tax you owe. You need not pay unemployment tax on yourself, although you must pay unemployment tax on any employees of the business. Of course, you won't enjoy unemployment benefits should the business suffer. So let's look at some of the advantages. Some of the advantages of a sole proprietorship. First of all, they're the most instant, easy, and expensive forms of entities. There's no state paperwork that is required for creation, and there's no separate legal tax filing that is required, as profits or losses are reported on the owner's tax return. The owner may freely mix business and personal assets, and they do not need to pay unemployment tax on himself or herself. The disadvantages of sole proprietorship are that the owner is subject to unlimited personal liability for business debts, losses, and liabilities. This is a very big issue. This is the main reason why you don't want to form a sole proprietorship. Also, obtaining capital such as bank loan can be more difficult, as lenders and banks often require a more formal entity structure. Also, sole proprietorships rarely survive an owner's death or incapacity. Also, sole proprietorship, by definition, can only have one owner.